What's going on, guys? Welcome back to another video. So in this one, we're going to be talking about, again, the overall market. We have a lot of things to look forward to going into these next couple of days. We have crazy earnings after hours today, a lot of economic data coming out tomorrow morning, as well as big oil companies' earnings. Next week, we're going to be going into the Fed meeting. But there's a couple of interesting things that I want to talk with you guys about. One, there is some interesting data and some other key research points that I want to talk with you guys about that do point to the fact that the market is most likely not done selling off. And this goes along with the TINA point, there is no alternative, TINA, that we've been talking about a lot. But the big situation here is this Credit Suisse bank run that essentially happened to them when all of these other media reports were saying that retail investors were coming out and making these wildly outlandish bets against Credit Suisse. But they reported their earnings today, and we have a lot more insight to talk about, just like I said we were going to when we got more data. So again, guys, before we get into all of that information, if you wouldn't mind hitting that like button down below, helps us out a whole lot in getting this information out to as many people who want to learn. And if you do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So getting into the charts over here, we're looking at the SPY on the 4-hour time frame. Now, we were looking at this yesterday in terms of where we were at in relation to this 200 exponential moving average. Now, recently, we have crossed down below the RSI's moving average. We're seeing this MACD starting to pivot down as well, losing that bullish momentum here. And we did see this slip of 380 here, that very, very key level. Now, again, the market is most likely going to be bracing for these earnings that are happening after hours today. And by the time you are watching this video, the earnings will have actually already come out. So we are going to be seeing a little bit more market movement. We have Apple's earnings, Amazon earnings, Intel's earnings that we all have to look out for. Big market movers there. Now, looking at this chart here, going over to the daily time frame, again, you can see there's just a lot of chop going on here. The market hasn't necessarily picked a direction, which is a little bit typical during earnings season, specifically this one. There's a lot of uncertainty as to whether or not these companies are going to be issuing guidance, reporting terrible earnings, reporting better than expected earnings. And the market is reflecting that here, but that doesn't mean that there's not money to be made. And I do want to highlight a couple of our members over here, lavishly killing it over here. L. Gene with a 23% day. DM Ohio, if you know anything about DM, he loves to play with some big money, so that 72% gain is definitely very substantial. But again, guys, I can show you guys the gains all day long. The results speak for themselves, but it's up to you if you really want to take that step and come into the best place to come and learn how to trade and take your trading to the next level. The psychological aspects and the risk management part of trading is the most important. We have an unbelievable method, the proprietary trading algorithms, all the alerts, the live streams, and curriculum videos, but those additional learning pieces are going to help you guys get to the next level. So if you guys do want to join, make sure you guys check out that link down below. But going a little bit further today, looking at the dollar here, it is headed higher. It was up about 0.84% at the current time that I'm recording this. Looking at the 10-year here as well, it was down about 1.42%, so you are seeing some bond purchases here. And the key thing to note about the 10-year is that it did slip down below, and we're talking about yields here, that 4% level, which is going to be a key part there. Just because, again, psychological levels there, if we end up getting to 4.5%, that's about where I could see a lot of big money stepping in to buy up that 10-year treasury yield, and that could, or the 10-year treasury bonds, pushing down those yields, and we could end up seeing that TLT play really start to pan out. But again, that's going to be a little bit of a ways away. Now, looking at Credit Suisse over here, this is where things get interesting. So Credit Suisse down 19.5% today on their earnings. Well, why might that be? Well, when we come over to this article over here, Credit Suisse crashes most ever after admitting it suffered a bank run and breached liquidity requirements. 2 weeks ago, the New York Times mocked, quote, amateur investors for piling up in a historic meme short bet against the troubled Swiss bank Credit Suisse, which it argued was nowhere near as distressed as rumors suggested when discussing the violent plunge in the stock price, said that the timing puzzled the bank's analysts, major investors, and risk managers. Credit Suisse had long-standing problems, but no sudden crisis or looming bankruptcy. Now remember, we were talking a lot about those credit default swaps, which were essentially ensuring against the bank's overall failure to repay some of its debt. Now, well, in retrospect, it did, because as today's shocking radical overhaul by Credit Suisse, which included massive layoffs, new equity injection, a strategic outside investor, apparently Saudi money talks, and fake woke anger about a certain situation here that I'm not familiar with, and a complete business restructuring showed the second largest Swiss bank was indeed on the brink. And it wasn't just on the brink of insolvency, as Bloomberg today also reports. The former Swiss banking giant was this close to a liquidity crisis too. On Thursday, Credit Suisse said one or more of its units breached liquidity requirements this month when depositors pulled their money amid speculation about the lender's turnaround plan. Translation: the bank admits it suffered a bank run, something which the New York Times should have been reporting on instead of mocking all those who are shorting the bank to oblivion, and as we now learn, with justification. Credit Suisse down 19.5% after earnings, not in a good situation at all. Now, the key thing that you need to realize here about this Credit Suisse situation is we've been covering this for a while. Remember, they ended up trying to take on more risk back in June. Well, it obviously didn't play out if they were this close to basically an all-out collapse there, and all the people that were betting against Credit Suisse had justification in order to do so. Now, we have to realize here is that Credit Suisse is most likely not the only banking institution or even a branch of a banking institution that is having some of these issues right now. With the overall marketplace, the high inflation, we're seeing rising interest rates. A lot of these large institutions are not adequately positioned for these types of market moves. And again, we know that Credit Suisse loves to take on risky business. Sometimes it's able to make them more money, but in these cases, in these market environments, people like or institutions like Credit Suisse are going to struggle significantly. So keep an eye on Credit Suisse here. Remember, UBS was another banking institution where those credit default swaps were skyrocketing. So keep a lookout for UBS as well. Now, going into the next couple of trading weeks here, I do want to bring up this data point right here. The big stock capitulation is yet to come, and they're looking essentially here. Stocks have more room to fall versus bonds, but the fall in stocks and bonds this year has only taken the ratio to just below its mean. And what they're looking at here is this ratio tends to revert to its mean, but with big overshoots. The stock bond ratio has much more room to fall. You can see that back in 2020, it fell very significantly. In 2008, the dot-com bubble, just before 1990 here as well, beginning of 1980, you can see that these ratios are pretty telling about where these market movements could go, and they like to overshoot, as we can see by this chart. The interesting thing here, though, that I want to go over with you guys quickly is this right here. This is the concept of TINA that we've been talking about a lot. There is no alternative. When inflation is high, equities have to compete with bonds as they begin to look less and less attractive, referring to equities. Today, the real dividend yield of the S&P 500 is negative 5.6%. Remember, the real yield is accounting for inflation, and the real earnings yield is negative 7.2%, while the real 10-year yield on the Treasury bond is at negative 3.5. Why bother with equities when you can get a comparatively juicy, less risky return on bonds? This is the concept of TINA. Remember, there is no alternative. Shifting to BAAA, bonds are an alternative to these equity investments. Remember, there's a lot of cash sitting on the sideline right now, and if you're going to take the risk in going into the equity market, basically based off the S&P here, where the real dividend yield is negative 5.6% and the real earnings yield is negative 7.2%, bonds are a lot more attractive than equities at this point. Now, can you make money on equities in the short term? Yeah, you absolutely can, but you have to know that you are taking on more risk, especially since we have not gotten that light at the end of the tunnel from the Fed in general. Now, the last thing that I want to touch on here before we wrap this video up is that the Bank of England confirms that the first quantitative tightening gilt sale will take place on November 1st. Remember, when the sales of these bonds are going through, it pushes yields up if there is not enough demand for these bonds as they are being sold. The Bank of England and the UK in general just saw massive problems with these yields skyrocketing out of control. Their pension funds were on the verge of collapse. If the Bank of England is not able to efficiently efficiently dump these bonds that they were purchasing in that little spree of quantitative easing, well, then we could be in for new lows. We could see the pound start to come down again. We could see the dollar come up, and that's going to affect our equity markets most likely to the downside if things start to get out of control again. So guys, that is mainly going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. I'll see you guys in the next one. Peace.